everyone. In today's video, we will be talking about the daily bias and draw on liquidity. The main focus will be on the daily time frame and on the weekly time frame. Right? Let's get to it. First of all, the easiest way to frame a draw on liquidity or have a daily bias is to use the previous day's high or low. If you look at your screen, we have two diagrams here. We have a bullish diagram and a bearish diagram. This is our previous day high, this is our previous day low, this is our previous high, and this is our previous day low. Right? So in order for you to draw a liquidity is to look at this candle. Both of these candles from this diagram, both of them, unless price is going to consolidate, we're expecting price to either take out the high, low, the high, or the low, or take out both high and the low, the high and the low. Right? In the bullish diagram, it shows a bullish momentum. Here, bullish momentum meaning that we have two candles that are bullish, right? No bearish candles. We expect price to come and take out the high before it takes out the low, right? We expect the price, the next candle that opens from here, we expect to come in and take out the high before taking out the low. And in the bearish diagram here, bearish diagram here, because we have a bearish movement, a bearish momentum, two candles going down, we expect the price to take out the previous day's low before taking the previous day's high, or in that we expect price to move down like the previous day's low's liquidity. Right? Your draw on liquidity. This previous day's high, this previous day's high, this previous day's low, or this previous day's low, it's our draw on liquidity. The easiest draw on liquidity is the previous day high because price closed near a previous day's high. So this is our next draw on liquidity before this becomes our draw on liquidity. In a bullish momentum, our draw on liquidity. Here, our draw on liquidity. Okay, moving forward, our draw on liquidity can act as two things. When the market gets on liquidity, can act as two things. A reversal with a continuation. What do I mean by that? Now we are talking about a reversal here. We think this is a reversal. Our previous day high was a draw in liquidity, and you can see this candle. This candle went up and closed the previous high and closed below this previous day's high. Right? So what that tells us is that displays high, meaning that the market has no momentum to go up, so we expect price to go down. Our previous day's high liquidity has been ran. Now we expect our previous day's low liquidity to be the market has displays above this high. Similarly to this bearish move, if you look at this, the market closed here and it opened here, then it went down and attacked the previous day's low, but failed to close below this previous day's low, closing above previous day's low, meaning that liquidity was scrapped. This was a liquidity gap. Now our previous day's high act as our draw on liquidity. Now information you see here, this diagram here, the market opens here short above the previous day's high and close up. Well, this tells us that the market has displaced above this previous day's low high with a displacement. When we see displacement, whenever we have a displacement in the market, we know that big players are or institutions are now involved in the movement of the market. Now this goes above the previous day high, signaling us that the market is rising further and further. Similarly with the bearish movement, the market shot down to attack the previous day's low, close below the previous day's low, showing us that institutional players, now the market will continue going down, right? So in recap, what we simply say is when you're looking at the price like this to determine your daily draw liquidity, you look at the previous day's high and previous day's low. Whatever momentum we have in that direction, you will first draw on liquidity. Here, a previous day high is a draw on liquidity. Here, our previous day low is a draw on liquidity. It can be used either to anticipate a reversal continuation. If the market of the previous day high, we know that we expect a continuation higher. But if the market goes up but fails to close above the previous day high, close below the previous day's low, I understand the theory part of the ICT daily draw on liquidity. Let's go to the market and look at it. Okay, we are on US 100, which is Nasdaq, and on the daily time frame. What you do here is you highlight your daily low. This is your daily low, and this is your daily high. See, here when up and it goes below this daily low, that we can expect market to continue and come below this our daily. For reference sake, this is our daily. So now and this low. We expect continuing this, this low to be taken. The went up, higher up, didn't take this high, but it was low and it closed below this low. So now we expect it to go down. The market took out high, market took out the market took out this high, closed above the high, look the previous the previous day, the previous or previous day's high. Where the market is, what do you see? The market that market has a bullish momentum or a bearish momentum. We look at this high, this high, look at which one the market is gonna take first. The market went up, failed to close above this high and close below this low. So now we expect the market and took out this previous day's low. The previous day's low was taken here. Now we expect the market to take out this low. Our draw on liquidity is complete. That's all you have to do. Look at the previous day's high and the previous day's low. Look at which momentum is it going to. Is it bearish or bullish? If it's bullish, we expect the previous day's high to be taken, and if it's bearish, we expect the previous day's low to be taken. Right? Another important sector for the daily buyers is the previous week's high or the previous week's low. What do we mean? What do we mean by what do we mean? A previous week's high or low are liquidity levels that can be used as a draw on liquidity or frame a reversal or a continuation. What do we mean? Similar to the daily, previous week's high and low are liquidity levels that can be used as a draw on liquidity or or to frame a reversal. Right? What do we mean by that? Here we have a previous day's week, the previous week's high, and the previous week's low. What do we have? This down momentum. We have this down candle going up. What do we expect on the daily time frame? This is a daily time frame, so 1, 2, 3, 4, 5 makes a week, right? Monday, Tuesday, Wednesday, Thursday, and Friday, right? If you can check here, we have this low been taken in the market closing below. We have this low been taken, the market closing below this low, showing us a bearish momentum, right? But when you get here on Friday, we see the market making this low, a previous week's low, previous week's low. And when the market comes and opens again, what does it do? The market opens here, go and take out the previous week's low, but fails to close below it. So When it fails to close below it and closes as a bullish candle, then we expect a reversal, right? A reversal, that means that the previous week's high now X our X as our and market will be drawn to this market. The market will be bullish until it takes out and put a new high. If you look at your on your left side of the screen, right side of the screen, this is now we are talking about a continuation. Now we have Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. We have every low the market is taken and it closed below the low. Low taken, close below. Low taken, low. Low taken, close below. And here it's a Friday, and we expect the market to come Monday, then the next week. This is our previous week's low and this is our previous week's high. The market opens here, sharp down the previous week's low and below. This tells us that the market will continue going down. In order to not make this video as lengthy as it could be, for here I'm only going to use two examples which are pre-selected. This price here is 1, 2, 3, 4, 5. We have 5 candles: Monday, Tuesday, Wednesday, Thursday. Doesn't matter whether this was a Monday, but I'm just giving an example. We have Monday candle closing up the high, the market closed up below that. Then the third day, the market closed above this high again. The third day, the market closed above this high and above this liquidity point, above this swing point. When it comes to Friday, the market made this high. Let me make this thing bigger. The market closed. This is our previous week's high. And what do you notice? The market on the next week opens here, attacked our previous week's high, but failed to close above it. So now we expect a reversal, which we got here. The market now started going. This XX, our draw on liquidity. Our draw on liquidity is here. The market will continue going down until this is taken, right? And if you can see again, 1, 2, 3, 4, 5. We have 5 candles. Let's count from 1, 2, 3, 4, 5, 6, 7, 8, 9. It took 9 days for the market to come back to this low. Now, for the last part of this video, we are going to talk about swing point, right? A swing high is a candle that has a lower candle to the right of it and a lower candle to the left of it. The middle candle is the highest, and a swing low is a candle that has a higher high, a higher candle to the left of it, and to the right of it. Swing points can be used to as a draw on liquidity because we know them that above and below every swing point there is a liquidity pool. There is a pool of liquidity. Right? Now, when we see this now acts as our draw on liquidity, in that now we know that below above every swing high there is liquidity. So we now expect the market to take this liquidity build down somehow. I'm not going to talk about swing high and swing points too much because I've talked about them in my liquidity video. So if you want to know about swing points, go and check out my video about that. For now, if you have made it this far, please consider subscribing and liking this video. Thank you.